Morning, everyone, and thank you very much for joining me. It's the morning market review. It's Monday, it's the 10th of October. My name's Russell Shum, Senior Market Specialist at FXCM, and my email address r@fxcm.com. Just going to bring up the high risk investment warning. Can also just confirm, can everyone hear and see the screen? Just want to double check that. Ladies and gentlemen, morning to you and welcome. Nice to have you in the webinar as always. Okay, cool, excellent. Right, let's just bring up our market commentaries disclaimer. Amy, good morning to you. Morning to everyone. I hope everyone had a good weekend. Let's see what the charts yield this morning. So we'll look at market scope, trading view, and I'm going to go through the Bloomberg email. 5 things to start your day. Let's put this on daily, actually. All right, so we'll come back to this chart in a moment. Let's just go through the Bloomberg email. First heading, finger pointing, Russian President Vladimir Putin accused Ukraine of carrying out an attack that badly damaged the key bridge linking annexed Crimea to the Russian mainland. His first comments on an episode that further highlighted the woes of his military in the 8th month of its invasion. The authors, the executors, the commissioners are Ukraine's secret service, Putin said at a meeting. I hope I read that right. The authors, the executors, the commissioners are Ukraine's secret service, Putin said at a meeting with Alexander Bestrykin, chairman of Russia's investigative commission, according to a transcript posted on the Kremlin website. Putin will now speak with members of his Security Council on Monday. The event typically gathers top state officials and heads of Russia's defense and security agencies to discuss matters of national importance. The clash of the Tories. Liz Truss is preparing for battle with the ruling Conservative Party as she gears up for crunch meetings with backbench MPs and a cabinet in a bid to quash any attempt at rebellion just 1 month into her UK premiership. A poorly received package of tax cuts and a fractious annual conference sent markets reeling and the Prime Minister's ratings plummeting, with warnings from senior Tories that the party could face oblivion in the event of an election. On Wednesday, Truss will directly address her mutinous rank-and-file Tory lawmakers in an attempt to reassert her authority. Getting her MPs on side is crucial for Truss to advance her growth plan through Parliament. COVID dilemma. As most of the world moves on from COVID-19, President Xi Jinping is set to trumpet his strict measures to control the virus at China's once in 5-year party Congress. The question now is how long they can last. Since the initial outbreak emerged in the central city of Wuhan, many people in China have been more or less supportive of mass testing, citywide lockdowns, and strict hotel quarantine, but signs are emerging that patience is wearing thin. However, any easing carries big risks and would undermine Xi's approach both at home and abroad, and risks making him look weak at a time when the Communist Party's leadership is facing criticism over a slowing economy. Next heading, brutal earnings season. So we're going to get earnings season is going to kick off this week with the banks towards the end of the week. Investors expect this earnings season to pummel stocks further and will watch Apple in particular as a bellwether of global economic conditions. More than 60% of the 724 respondents to the latest MLiv Pulse surveys say this earnings season will push the S&P 500 index lower. That means no end in sight to the dismal run for stocks after a tumble Friday decisively dashed hopes that the eye-popping rally early last week would be the start of something bigger. The results underscore Wall Street's fear that even after this year's brutal sell-off, stocks have yet to price in all the risks stemming from central banks' aggressive tightening as inflation remains stubbornly high. Just a few more things to say. Goldman Sachs CEO David Solomon once predicted the firm would be a leader in retail banking like it is on Wall Street. The expansion proved expensive. Solomon, 60, who spent much of his 4 years atop Goldman pitching shareholders and his own executive on the benefits of building a full-service digital bank, is now reeling in those aspirations. and the resources dedicated to the project cost overruns and missed profitability goals have set off a rising tide of discontent inside the firm. Concerned questions from regulators are most worryingly the dismay of shareholders. What's coming up today? European shares are poised for a soft start to the week after a strong US jobs print bolstered wages for more aggressive Fed hikes. The IMF and World Bank kick off annual meetings in Washington. The ECB's Mario Centeno and Philip Lane speak at events, while the Fed's Lael Brainerd and Charles Evans addresses a conference. Russian President Putin has called a meeting of his Security Council for Monday. Norway and Denmark issue inflation data. It's a light day on the earnings front. All right, that was quite a lot to get through. So I think that we start off exactly where we've been starting off for a number of months now, and that is with the real rate. We're looking at the daily, and what we want to do here is get an idea of what's a potential next movement in real rates, and we just want to watch this this level here. So there's the reference candle, there's the completion of the reference candle, and now what we want to do is we want to see if there is going to be an impulse. Okay, let's go down to the dollar. Okay, this is the low here. All right, so there's the completion, and now the similar assessment over here. All right, and this looks quite intriguing. It looks quite dangerous actually in terms of the real rates. When I say dangerous, I'm talking time value of money. Remember, the higher the real rates go, the more pressure on the present value. So you can see that the real rates looking quite positive. You can see the dollar responding well, and we can throw in, let's put in the S&P 500 underneath. All right, and what we have here is the opposite, right? You've got this push down here, and here's the reference. Okay. So it looks like we're getting another lower peak here. And what's going to be very interesting is effectively this earnings season. I just want to talk about that for a few moments, and then we'll start looking at the charts again. So we've looked at time value of money calculations previously. Let's just put that in. So we've got present value equals, let's put cash flow, okay, divided by 1 plus, I'll just put interest rates here. To the end. All right, so we've got two things I think that we need to keep an eye on here. So we've always been looking at interest as the variable that's putting pressure on the present value, but of course now the numerator is going to come into focus. In other words, are there going to be any cuts in dividends? That would be, I think, quite devastating for an already battered market. Hey, Katie, good morning to you. I want to show you, we've always looked at just the time value of money. To do discounted cash flows, there is something called a terminal value. I just want to talk about a terminal value now. I don't want to get too much into the calculation of discounted cash flows, but the terminal value is actually the majority of the value. It's the majority of the present value. And the way that the terminal value is calculated is through, there's a few ways to do it, but perhaps the most academic way is something called the Gordon growth model, which we have talked about previously. So the Gordon growth model basically dividend, okay, just thinking the best way to represent this. I'm going to do it like this. Okay, so this looks quite complex. I'm just going to show you what we've got. Just think about it in terms of numerator, denominator, okay? So the numerator over here is effectively the dividend, but it's actually not looking at this year's or the current dividend. Gordon growth model is looking into the future, so it looks at future dividend, and that's what G is. G is a growth rate. So if there's any indication that the growth rate is starting to decline, so if we get some forward guidance where they say, well, next year doesn't look particularly good, that's going to affect the Gordon growth model. And then at the same time, there is a lot happening on the denominator side. But the point is that I think the terminal values potentially come under pressure here. Okay, and I think that the cash flows come under pressure here. So I think that we are in for quite a difficult earnings season, and that basically is what we're seeing in the charts, right? So here's the S&P 500, and it's pushing down. Well, why is it pushing down? It's because your terminal values now are starting to discount earnings season. I think more so than anything is that there's a concern about growth rates. There's a concern now about future dividends. There's a concern about cash flows coming out of the market. And now that's on top of the fact that interest rates are moving up. So we're moving into a very interesting time on the share market. Let's just throw in the Nasdaq 100 as well. Okay, here you can see the growth sector also under huge pressure. So let's also throw in the DAX here. Okay. Okay, there's the reference. Okay, reference completed. So you can see we're moving into a tough week. You're looking at the daily, right? So we'll look at this again tomorrow, but we're getting multiple things happening here. The one is the interest rate appreciating, okay? The second is now terminal values, discounted cash flows, adjusting to poorer earnings. Let's just carry on this line of thinking just to tie everything together. Let's go back to Dow theory. So we'll go here, and remember there's 3 stages to the bear market. It's very difficult to actually assess with pinpoint accuracy, but we know we've passed stage 1. The hope's been abandoned, right? Abandonment of hopes. Okay. Now the question is, are we past the second stage? Are we into the third stage? The second stage is decreased earnings. Yeah. Decreased earnings, and of course there's still a panic selling stage. So those are the stages of a bear market according to Dow theory. Remember, Okay, the higher interest rates, okay, the terminal values now that are adjusting. So we definitely, at the very least, in decreased earnings, at the very least, but we could be sort of into sort of the stage as well. Now, we want to keep an eye on this. It's a theoretical model, of course, but I think it's a good way of sort of assessing the market, because after that panic selling, we're going to get into renewed confidence. Now, renewed confidence is an interesting stage because nobody wants to touch stocks at this, except for the pros. Renewed confidence. So at some stage, renewed confidence is going to come. I think that, you know, we're not there yet, but we'll carry on assessing decreased earnings into panic selling, into renewed confidence, what's happening on the interest rate side, and let's go back here. Let's actually bring up this. Yeah. Incidentally, what this is the participation rate. So whilst the job numbers were good on Friday, the participation rate's falling. In other words, there's less people in the counted as actual workers. So that was, I think, this is quite a interesting part of the dynamic. Nevertheless, let's just go back to SPX 500 and put in the COPOC. Remember, it's done on the monthly. Just putting in 0 here. We can see it's below 0. Sorry, that's not the right tool. I want this one. Yeah, that's better. And let's just throw in that 3-period EMA just as a signal line. Okay, cool. So, you know, when we start getting the COPOC above this signal line, I think we can start actually talking about moving into this renewed confidence stage. So we're quite obviously not there yet. It's going to take a number of months before we kind of get an assessment here. Remember, we're looking at this on a monthly. So at the beginning of the month, at the end of the month, we can take a look at this. But the point is, I think this earnings season has potential to be extremely rough. Let's sort of acknowledge that. Now, let's bring up this chart here. Okay, so this is gold. Before we look at gold, let's go to the US dollar here, because we've seen the US dollars responding to the real rate. Okay, so we'll just get an assessment. So we're not overbought. I mean, we're getting pretty close to overbought, but we're not there yet. There is just an absolute runaway train of positive momentum here. It's unreal how strong the dollar is at the moment. And the fact of the matter is there is now the flow on effects, and the flow on effects can be seen on gold. So I'm going back to gold now, and you can see here, this is gold. So we've got low peak, low trough, low peak, low trough, low peak, low trough. Okay, let's just add in some of these. All right, and then take a look at the price action here. It will be clear on the daily, but I just want to point it out on the weekly. So here is last week's candle. We closed here. We've opened pretty much where we closed, but look how much lower we are. This is, in other words, we're at an inside candle here. Okay, we're starting to chart an inside candle, and actually, now that I think about it, that's probably not even the place to focus. I think that you can see the reference candle sitting up here. Let's just go to the daily, and you can see here on the daily that we've now moved from this zone 1. So it's clear now we've gone into that zone 2. While zone 2 is neutral, of course, the fact of the matter is it is a relative weakness from zone 1 into zone 2. What are these? These, I think, are 2 periods. We can take these out. Yeah, this is going to confuse the issues. I think I was just testing these before the day trading workshop. Okay, so let's just take that out. All right, and the momentum here, whatever momentum we potentially could have had in the gold, looks as if it's starting to wane. So if it goes below 80, and the fact we've moved from zone 1 to zone 2, well, that's dollar strength right there. Okay, the movement from zone 1 to zone 2, relative weakness. Can we take advantage of this? I think that this length over here is really well into it. So if someone was to short gold at this stage, you really got to hope that the stochastic stays under 20, right? So that's the one way to take a look at it. The other way would be to wait for the pullback and see if resistance comes in, kind of moves us down. So while it's obvious that we are weak on the weekly, it's obvious that we're weak on the daily. We're probably a little too far on the hourly. Not to say that the trades couldn't pay off, but it really depends now if the fear sentiment holds, because in order to get the momentum build below 20. Let's just take a look at a few currencies. Let's bring up Euro. Okay, so you've got a similar story here. It does look as if we're getting the lower peak here. The Euro momentum is very much an obvious placement for a downward bias. We've now moved from zone 2, we've gone into zone 3. The stochastic starting to roll over. Taking a look at the hourly, gee, you know, it's so far along on this leg. Do we want to get involved? So I think you guys know Euro is probably sort of my go-to instrument when I'm looking to trade. For me, I think this is, so I don't have a position on it at the moment. I think this is a little too far along. What I would like is some sort of pullback and then get in on a risk-adjusted basis. But certainly it's looking very weak, isn't it? Let's just take a look at cable, which is in the headlines as well, and we'll do a top down. So we go through to weekly, and the sell-off to 103 here. Okay, found support. It's pushed all the way back up, but it looks like we're getting this LP, and I actually think that cable looking quite fragile here. So we'll just keep an eye on it. I wouldn't be surprised to see more weakness, and the momentum certainly in the area where there's much more, one would suggest, weak momentum. Not weak momentum, it's actually strong momentum, but it's strong momentum to the downside. Okay, and if we go through to the daily, so we're now starting to move back towards zone 3. Take a look at the stochastic rolling over, right? Is this something we can take advantage of? Again, it looks like this move's probably done. I mean, I can't guarantee it, of course, but this looks like 1, 2, 2, 3, 1, 2, and then you can even see the stochastics kicking up a bit. So any sort of resistance at central pivot or R1, I think, is something that the market will certainly be considering. Can we explain how the movement from panic selling to the next stage? So you can't pinpoint it with any absolute accuracy. You know, you've got to be quite discerning with the way that you analyze in the market. So one of the factors that perhaps makes it a little less objective would be the COPOC indicator. In other words, if the COPOC moves above its signal line from below 0, that potentially could be meaningful, but it's just one tool in your toolbox, right? You can't be beholden just to the one tool. So if we see some sort of bullishness coming out of the COPOC, fair enough. That means that we've got to start looking at from a other angles as well. So you're never going to have any sort of absolute certainty. I've never used the COPOC. Did you have a session about it? No, I don't think we've had a session about it. I can't remember. I don't think. It's just something that I've introduced. Look, the COPOC to me is sort of a very underutilized indicator. It's only utilized on the monthly. I read an article about it on stockcharts.com, and I haven't read it lately, but their interpretation is not something that I agree with. It doesn't fit in with Edwin COPOC's original signals. I'm not sure if they changed it. On the stock charts, they said it as sort of 0 is your trigger line, so they're looking for it to break above 0. That's not the way Edwin COPOC used the indicator. He used it when it ticked up from under 0. So so the idea here is I've just added a 3-month exponential just to help us be a little bit more subjective. The point being, we don't have the signal yet. So, and we're going into a very hard earning season. You can see this is the 2008 global financial crisis into 2009. I mean, it went all the way down to -74, right? So I don't know where we're going to end up here, but it's, you know, until we get that kick up, we're just going to have to monitor it. Zanette is saying S&P chart is on the 200 EMA. I can throw in an EMA here. So it's not a way that I often look at the market. Using the 200-day exponential moving average just never made sort of intuitive sense why it's the line in the sand. I guess maybe the way that we can interpret it is because other market participants are looking at it, it's like a fib, right? It's probably a self-fulfilling prophecy, prophecy, I guess. Hang on a second, what am I doing here? Oh, wait a second, it's got to be on the daily, 200 on the daily. Yeah, sorry, the 200-day, it's generally looked at, not on the monthly, it's looked at on the daily. So we're actually below the 200. 200 monthly is going to be way too long. But I think that peak and trough analysis is going to I think peak and trough analysis is going to serve you better, in my opinion. I mean, all right. Katie just asking for oil. Let's take a look at oil. All right, let's start from a top down. All right, so OPEC Plus has cut their production. Oil markets have responded. Again, this is actually a good example to use peak and trough analysis. So we've got peak trough, low peak, low trough, lower peak. Let's put this as the lower trough here. Let's put this as the lower peak. All right. And here's the lower trough. I think, Katie, then this is the this is, I think, the key level here, because if we move above this level, which is, what is this level? 105. Then we don't have lower peaks, right? Then we'll get the higher peak. So what does that do? That would effectively end the downtrend. Okay, that would end the downtrend. And then how would we get the uptrend? Like that. Okay, like that. So I think that, yes, there has been a big movement in oil. There's no doubt about it. It hasn't ended the downtrend yet, but there does seem to be something in play here, some sort of movement. Let's see if the stochastic moves above 20. Let's see if RSI moves above 50. Those in of themselves would be bullish. And what we can do is also monitor the daily over here. So ideally, the weekly chart breaks out of this downtrend. Of course, if one is looking for to be an oil bull, because it's a weekly chart, it will take longer. The daily chart has moved into zone 1, and the hourly chart here does give some sort of bullish signal. Just understand that the primary trend actually still very much in flux at the moment. So the primary trend still needs to adjust to what we've seen coming out of OPEX. But in terms of your daily, yeah, we are in zone 1. Okay, on the hourly, yes, there is looking like we're going to get some bullish crosses here. And of course, if it comes into the 80 area and holds, then oil does have most likely legs, and we get ever closer to breaking the downtrend. Okay, so that's kind of what's happening at the moment. It's really just adjusting from the news out of the latter part of last week, and we'll keep an eye on that. I hope that helps, Katie. All right, any other questions, guys? Any other questions? Let me know. Okay, I think what we'll do, let's wrap up here, and if there's anything you need, just send me an email. And have a good day, a good evening, and we shall chat tomorrow. Thanks very much, guys.